on the floor. They don't ask, they wait.
They don't know why they turned. They only know everyone else did. Birds, fish, crowds, investors. The species changes, the behavior doesn't. The crowd offers something powerful. Comfort. The comfort of belonging. The comfort of agreement. The comfort of knowing thousands of other people are doing exactly what you're doing. That comfort has built civilizations. It has also destroyed fortunes. Every great trend begins the same way. First they ignore it, then they laugh at it, then they attack it, then they chase it. The internet followed that path. In 1994, almost nobody cared. By 1998, curiosity exploded. By 1999, people were borrowing money to buy anything with a .com attached to its name. The crowd had finally arrived. That was the problem. The crowd never buys value. The crowd buys certainty. And by the time certainty arrives, the opportunity is usually gone. When everyone agrees, risk often hides in plain sight. When everyone disagrees, opportunity often does the same. The same crowd that pushed prices into the sky helped drag them back to earth. The internet did not fail. Human psychology did. Technology changed the world. The crowd simply arrived too late. The lesson was never about technology. The lesson was always about behavior. The story keeps changing. The crowd doesn't. .com, housing, crypto, artificial intelligence, different decade, same emotional pattern. Excitement becomes confidence. Confidence becomes certainty. Certainty becomes euphoria. Euphoria becomes blindness. The hardest part of investing isn't buying. It isn't selling. It's waiting. Most people can survive fear. Few can survive boredom. Patience feels unproductive, until suddenly it becomes priceless. The crowd wants movement. The market rewards preparation. Most fortunes are not built during excitement. They are built during periods when nothing appears to be happening. The crowd sees dead money. Professionals see accumulation. The crowd sees delay. Professionals see positioning. Fear creates opportunities, not because fear is pleasant, because fear creates distortion. The crowd begins selling for emotional reasons. The professional begins buying for logical ones. Both see the same event. Only one sees it clearly. Then comes the part nobody remembers. Recovery. The crowd always returns. It returns after every crash, every recession, every panic, every prediction of doom. History has been remarkably consistent on this point. Human beings adapt. Markets adapt. The crowd forgets. The crowd is not your enemy. The crowd is your teacher. Watch it, study it, understand it, but never surrender your judgment to it. Because every great opportunity begins the same way. Few believe, then some believe, then everyone believes, then it's over. Your job is not to follow the crowd. Your job is to understand it. And when necessary, walk in the opposite direction. FMV, or fair market value, is the price that a knowledgeable, willing, and unpressured buyer would pay to a knowledgeable, willing, and unpressured seller. It's a concept that is central to economics and finance, reflecting the highest price a buyer is willing to pay and the lowest price a seller is prepared to accept. FMV is influenced by factors such as an asset's condition, age, market conditions, and earning potential. FMV in economics and finance. FMV is pivotal in various financial transactions, including real estate, mergers, taxation, and insurance. It helps determine asset selling prices and assess value for tax purposes. In finance, FMV affects a company's financial standing and creditworthiness and guides investors in evaluating the profitability of investments. Mass psychology and contrarian thinking in FMV. Investor sentiment, driven by news and economic indicators. significantly impacts FMV. Public opinion can drive prices up or down, affecting FMV accordingly. Contrarian investors use this to their advantage, often going against market trends to capitalize on mispriced assets. They sell when overexuberance inflates FMV and buy when pessimism undervalues assets, potentially achieving greater returns. Traditional methods of determining FMV. Traditional FMV determination methods include comparative, cost, and income approaches. The comparative approach looks at similar recent sales. The cost approach estimates replacement costs while accounting for depreciation. The income approach calculates the present value of expected future cash flows. The choice of method depends on the asset type, valuation purpose, and available information. Supply and demand's role in FMV. Supply and demand significantly influence FMV. High demand with limited supply can raise an asset's FMV, while excess supply can decrease it. Investors' perceptions of an asset's future value also affect its current FMV, with a willingness to pay a premium for expected value increases or reluctance to invest in anticipation of a decline. Balancing mass psychology and contrarian thinking. Investors need to balance understanding mass psychology with contrarian thinking. This involves anticipating market sentiment and identifying mispriced assets. While mass psychology provides insights into current sentiment, contrarian thinking identifies profit opportunities. Objectivity and independent thinking are crucial in this analysis. What is contrarian investing? Before we dive in, let's clarify what contrarian investing is. In simple terms, it's the art of going against the grain. Instead of following the crowd, contrarian investors look for opportunities where the market might be underestimating or overestimating a stock's value. It's like finding hidden gems in a sea of noise, the crowd mentality. Let's face it, the market is often driven by emotions and herd mentality. When everyone is rushing to buy a particular stock, it might be time to take a step back and reevaluate. Contrarian investing thrives on the principle that the crowd isn't always right. Tip number 1. Be skeptical of hype. When a stock is all over the news and everyone is talking about it, it's easy to get caught up in the excitement, but contrarian investors know that hype doesn't always equal long-term success. It could be a bubble waiting to burst. Tip number 2. Embrace unpopular choices. Contrarian investors aren't afraid to swim against the tide. Remember, some of the most successful investors made their fortunes by investing in stocks that others were avoiding. It takes courage, but the rewards can be substantial. Tip number 3. Patience pays off. And our final tip, patience pays off. Contrarian investing is about playing the long game. It might take time for the market to catch up with your insights. Don't be discouraged by short-term fluctuations. The real gains often come to those who can patiently weather the storm. Success stories. Still not convinced? Well, let me share some success stories of contrarian investors who went against the crowd and came out on top. These stories are not just inspiring. They show us that with the right strategy, anyone can outsmart the market. There you have it, fellow investors. Contrarian investing tips for outsmarting the crowd. If you enjoyed today's video, don't forget to hit that like button, subscribe to Tactical Investor, and ring the bell for more insightful content. The best investment advice. Don't listen to experts. Do not listen to self-proclaimed individuals who claim to be experts, for they probably know even less than you. For the record, at Tactical Investor, we never refer to ourselves as experts. At most, we use the term advanced students. A student is willing to continue the journey, while experts are at a standstill, falsely assuming they know all there is to know on a given subject. Hence, experts and masters are akin to bad students. They do not want to learn anymore. Therefore, if you visit popular sites, take their data with a jar of salt and a shot of whiskey. In other words, don't assume they have your best interests at heart. Emotions are dangerous when it comes to investing. One needs to understand that emotions are the most dangerous instrument when it comes to trading. Those who allow their emotions to do the talking usually allow their money to do the walking. In other words, if one makes any decision, especially a financial decision, that is emotionally based, the odds are relatively high that the outcome is going to be far from positive. Be open-minded and willing to learn new concepts. Read some of the books mentioned earlier in the update and look at how individuals reacted during previous market crashes and what made them throw caution to the wind. One can glean a plethora of data by looking at how the masses reacted to previous end-of-the-world type events. In every instance, you will find that the masses always lost. They always bought at the wrong time, and their timing when it came to selling was even worse. Technical analysis. A brief overview. At Tactical Investor, we use custom-based indicators, but the point is not to try to match what we do or what others do. The goal is to understand what oversold and overbought conditions entail. Once you understand that concept, you can play around with the settings. This is discussed in Part 1 of the trading manual. Additionally, you do not have to use only popular tools such as MACD and RSI. You can look for indicators that appeal to you. The idea is not to copy what someone else is doing, but to use the concept as a basis for creating something that works for you. We have subscribers who don't like the RSI or MACD. They have replaced one or both with other indicators and are quite happy with the results. Tactical Investor subscribers are entitled to a free trading manual. The whole purpose of this manual is to teach one how to fish and not make one dependent on the trading style of another person. Start slow, and as you practice, concepts that made no sense to you before will gradually begin to make stock market crash myths. Focus on the fear factor and obscure opportunity factor. Our overall philosophy is to let the trend do the talking, especially in this day and age when market manipulation is the order of the day. The markets are not free. Corrections end at arbitrary points. In other words, the top players decide when the stock market crash myths. Focus on the fear factor and obscure opportunity factor. Our overall philosophy is to let the trend do the talking, especially in this day and age when market manipulation is the order of the day. The markets are not free. Corrections end at arbitrary points. In other words, the top players' stock market crash myths. Focus on the fear factor and obscure opportunity factor. Our overall philosophy is to let the trend do the talking, especially in this day and age when market manipulation is the order of the day. The markets are not free. Corrections end at arbitrary points. In other words, the top players, what they forget is that they were doing the exact same thing yesterday that they are doing today. This is one reason the market is likely to soar far higher than most expect. Many investors fall into this category, and the sad part is that they do not even realize that this mindset will eventually push them to buy near the top out of frustration. There is no such thing as a perfect entry point. If logic governed the markets, then everyone with a PhD would be rich. If reason governed markets, then the most educated people would consistently achieve the highest gains. Instead, many of them consistently lose. You need to change your mindset now and throw fear out the window. Stop waiting for others to give you the push you need to give yourself. You cannot expect someone else to dig you out of the hole you dug yourself into. Your biggest problem is fear. The second is anger and frustration from missing the move. The longer you hold on to the old mindset, the more gains you may lose. You have two choices: change today or risk losing even more opportunities. While we do issue targets, we understand that major indices may or may not hit those targets because there are very few true free market forces left in play. The top players often decide at what arbitrary levels corrections end. This is another reason markets experience such extreme moves, as predicted in advance by our RV indicator. So the solution is simple. Make a list of stocks, ETFs and shares you want to buy. And wait for pullback. If you do not want to do the work yourself, you can follow the stock plays we issue. But remember, there is no perfect entry point. If such a moment ever appears, it is usually luck. If you wait only for that perfect moment, you will miss the entire move up. The second option is to continue doing what you are doing now and hope the outcome changes over time. But remember, the definition of insanity is doing the same thing over and over again while expecting a different result. Right now, the trend in the major indices is still up, so focus on that, not on the noise. Strong pullbacks are buying opportunities. The stronger the pullback, the better the opportunity. It is still a bit early to say what the market will do next year, but signs already suggest that another strong year could be ahead. Once again, those waiting for the ideal entry point may be left behind. They will look back at today's prices and wish they had bought, just as they now look back at 2014 and wish they had acted then. What separates today from yesterday? Nothing. They are still being held back by fear, and then suddenly they try to act because they are angry that they missed the move. Masses will jump in near the top. Mark our words, many individuals will jump into the markets very close to the top. At that point, euphoria will be setting in, and it will be time for us to leave. What we find strange and amusing is how people persuade themselves to buy in the future when the market is extremely overvalued, yet hesitate to buy now when valuations are more normal. Do not join this crew. Even though they claim they want change, they keep doing the same thing repeatedly. If they would simply sit down and examine their past decisions, they would see that the same emotions are driving them today. That is why they are destined to lose using the same failed methodology. There is a name for this: insanity. If you are part of this group and want to break free, then force yourself to go against your emotions. Do the opposite of what your fear tells you to do, especially if that fear has repeatedly failed to produce results in the past. Going forward, view every strong pullback as a buying opportunity. Change will not come from standing still. If you look at history, going all the way back to the tulip bubble, one theme rings out loudly. The experts always claim to know exactly when the market is going to crash. Interestingly, these same jackasses had no idea when the market would take off. But suddenly, they have become experts regarding when the stock market should and must crash. Hidden in this rhetoric is a theme that the masses, in most cases, fail to spot. Otherwise, these snake oil salesmen would have been out of business long ago. These chaps were wrong so many times that, had you listened to them, you would have bankrupted yourself several times over. Note that even a broken clock is correct twice a day. Hence, even if they eventually get it right, you would have been blown out of the water long before that happened. Fear and misery love company. So this is the favorite question of individuals who love to live in a world where negativity is the order of the day. If you live in the if world, you will miss all that is taking place around you, including opportunity. You will be so busy looking for reasons to justify why things won't work that even if opportunity slapped you in the face, you would not notice it. In short, one should never panic when it comes to investing. If you use common sense and take a few prudent measures, you won't have to deal with such a scenario. We have always believed that stock market crashes are nothing but opportunities in disguise. If experts could predict the exact time markets would crash, they would not be telling you. They would be busy playing the markets and making a fortune, because they can't predict anything other than the fact that you will buy their nonsense. They come on TV and sow doubt. They repeat the same message over and over again, hoping that by some miracle they will be right once, so they can use that single instance to advertise their supposed powers of prediction. This excerpt from an article we penned clearly reveals our take on experts. We have one expert after another predicting that it is time for the markets to crash. Mind you, these same chaps were singing the same tune in 2015 and 2016. and they continued singing it with the same passion in 2017. There's one noteworthy factor though. A few former bulls have joined the pack. Does this now mean that the markets are going to crash? Apparently not. At least, not if you look at the indices. The market continues to trend higher. Furthermore, what is a crash? A pullback? Or a correction? Does it not all boil down to perception? One individual could view it as a crash, while another views it as a mild correction and an opportunity to purchase more shares. It all depends on when you entered the market. If you embraced this bull market in 2016, then a pullback of 10 to 15% might feel like most experts almost gleefully try to force their twisted perceptions on everyone else. Just because the experts decide to label it as a crash does not mean you should follow their lead. Experts are known for getting it wrong all the time. In fact, experiments have shown that monkeys throwing darts at a random list of stocks often fare better than Wall Street experts. Hence, take their so-called sage advice with a barrel of salt. If the stock market crashed and dropped by over 20%, or even as much as 30%, what would you do? Jump up and down with joy. For when there is blood in the streets, the prudent investor backs the truck up and purchases all the quality companies the masses are dumping. Stock market crashes are hidden opportunities waiting to be discovered. That is exactly what the smart money hopes the masses will never figure out. We penned another article that deals with this topic very nicely. A market crash can be viewed as a monumental tragedy or a splendid opportunity, depending on what side of the fence you sit on. Perspective changes everything. If you decided to pour all your money into the market close to the top, then it would be viewed as a tragedy. If, on the other hand, you got in early and, as the market trended higher, banked some of your profits, then it would be viewed as a grand opportunity. Crisis investing dictates that all disasters are nothing but opportunities. Change the lens, and the picture changes. Always remember that fearmongers are paid handsomely to stampede the masses, for that is when the smart money makes the biggest killing. For them to make a killing, they have to fleece thousands upon thousands of small players. In some cases, they go for the jugular and fleece millions. Two examples come to mind: the dot-com bubble and the housing bubble. Everything you process is based on perception, and perception is based on the data you are fed. Alter the perception, and you alter the outcome. How do you know if you are even seeing the right picture? If all the information being provided to you is manipulated, that means the image you are creating from this data is also uncertain in nature. This is the tool that Wall Street employs with impunity. They use it all the time to create boom and bust cycles. The masters of data manipulation, however, are our lovely Federal Reserve System and the Bureau of Labor Statistics. Perceptions are created via brainwashing programs that are psychological in nature. Psychological conditioning starts the moment a child enters the public education system. Once they leave the system, it's game over for over 90% of individuals. The remaining 10% cannot bring about meaningful change because they rarely control the levers of power. In most cases, they never attain very high-ranking positions, so they exist on the fringe. They may garner some followers, but never enough to create meaningful change. All forms of media that cater to the masses have one thing in common. School is nothing but one massive brainwashing factory. The goal is to redirect your perceptions so that you see what they want you to see. This is why the media constantly bombards you with the same stories over and over again. Repetition is the best way to implant something into unsuspecting minds. These thoughts become embedded into the psyche, and the individual then assumes they are his own thoughts, when, in fact, they are not. This is why there is an active effort to get rid of homeschooling. Homeschooling promotes free ideas, while government schooling suppresses independent thought. In Germany, homeschooling is a crime. Imagine that. How conditioned do people have to be to accept a state that bans parents from educating their own children? The perception is changing. The masses are now becoming optimistic. Thus, Unless the trend changes, we can expect the markets to rally even higher. One other thing to understand is that even though the rally has been artificially induced, the markets have recently issued a true bullish signal. What is this signal, you ask? Both the Dow and the S&P 500 are trading at new highs. A true bull market is not in session until the old highs have been taken out. 9 out of 10 times, when this occurs, the market rallies significantly from the breakout point. The breakout point in this case is roughly 14,200, the old 2008 high. Market update, December 12, 2013. The truth or a lie is often not based on reality, but on what you perceive reality to be. Perception is everything. Not looks, not money. If you can alter perception, then you can recreate any reality, or alternate reality you want. It appears that the breakout to new highs was indeed a bullish signal. This was not an easy call to make, given that the markets had risen so much over such a short period. Now that the Fed has seen how easy it is to recreate reality, watch how the level of conditioning increases exponentially. People who use common sense will start to feel like aliens in this world, for the majority of the populace will be operating in an alternate reality. You won't have to watch a TV series about the living dead. You will start running into them everywhere. Soon, the first place you will notice this is within your own family and among people you thought were your friends. "Welcome to my world," said the spider to the fly, to which the fly responded, "Which one?"